Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. The federal government will announce its fiscal update this afternoon. According to recent data, Canada ran a budget deficit of close to $26 billion between April and February, well short of the $78 billion that was forecast in the annual budget plan. Prime Minister Mark Carney saying yesterday the update will deliver encouraging news on the country's public finances. And join us today for our coverage on the close, special live coverage of the spring economic update beginning at 4 Eastern. We'll bring you real-time developments, expert analysis, and what it all means for the market and Canadians. Shares of Celestica are under pressure. Look at that, up by 14% right now. The maker of electronic components reported first quarter profit and sales that beat estimates, but investors are noting the results didn't meet high expectations. Celestica also raised its full-year forecast for revenue and profit and expects to grow revenue by more than $6.5 billion in 2026 and 2027. Celestica had been facing high expectations going into the quarter, with the stock rallying 51% over the past month. The United Arab Emirates says it has decided to exit OPEC and OPEC Plus as of May 1st, in line with the country's strategic and economic long-term plan. Following the exit, the UAE says it will continue to act responsibly and gradually increase production in a measured manner aligned with demand and market conditions. The Middle Eastern country adds the decision is based on national interests and points to the evolution of policies in the sector. And a quick look at the markets. You can see it's off by about a half point, being dragged down by tech and materials. Tech, no surprise on those reports we're hearing about OpenAI and other issues and concerns, and materials down. At one point, it was down by about 4%. South of the border, and it's a mixed bag down there. The S&P 500 off by about 0.6. The Dow up ever so slightly by 0.09. And look at the NASDAQ off by 1.13 on all these reports when it comes to the tech companies. They're taking a hit today. Well, later this afternoon, the federal government will present its spring fiscal update. Prime Minister Mark Carney saying yesterday his government is determined to get spending down. Let's get more on this with our next guest, Rob Tetreault, branch manager, senior investment advisor, and senior portfolio manager at Canaccord Genuity. Rob, thanks very much for joining us.
Thanks so much for having me.
What are you expecting with this report?
Well, obviously, the top line number, if this was like an earnings call or something, or they were releasing earnings, the analysts would be expecting something, I think, in the 45 to 50 billion for the 25-26 fiscal year. I think the latest fiscal number that came out after 11 months was around 25 billion. Historically, March is a bit of a spending month for the government. So if we say maybe another 25 billion there, we're kind of in that 45 to 50 billion range, I think is going to be the number for the deficit for the year, which is obviously ahead of expectations. So did we beat expectations, or did we just kind of benefit from, oil prices that were a little higher and a little bit more taxes, et cetera? So that's kind of the number I'm seeing. 45 to 50, I think, is what we'll see.
And how do you see the market reacting? The market being Canadians in general?
Honestly, not much. I don't think people care so much about what I think it's already priced in. I think we kind of know what this number is going to be. I think most portfolio managers, analysts already know that, the number is going to be give or take around there. There's been enough hints. There's been enough breadcrumbing on behalf of the the Prime Minister's office. So I think we're going to see not much. Now, if the number is significantly different and if there's kind of a big headline along with that spring update, we might see a move. But otherwise, I think you're going to see muted market movement on behalf of this announcement alone.
And are you expecting any new announcements that might drive growth?
They talked about that sovereign fund yesterday. I know you guys covered it at length. So, does the market see that as progress? We're leveraging our own balance sheet to own equities as a Canadian. We're hoping to move in the direction of Norway. Is that good? I think the market probably sees that as good. So, maybe more news on that would be positive. But I don't see anything big. And if yes, maybe I'll be surprised.
All right. And with the, of course, Bank of Canada announcement coming up tomorrow, it looks like it's going to hold. Will any of this, the report today, have any impact on that? Either, not this one, obviously, but down the road, can we expect that to have any impact? And what are we looking for tomorrow?
Yeah, I think tomorrow is going to be, you got it. I think you nailed it on the nose. We're not going to see any move tomorrow. It's going to be a status quo. But I think we're about to see potentially some change here with respect to the Bank of Canada, these interest rate decisions. If we look at 3 months ago, what were we expecting? We were expecting, at least status quo for this year, maybe a little bit of cutting, talk of cutting in 2026. That talk is now gone completely. I think this this Middle East crisis is on everyone's mind. These economists, these analysts, I think the dot plot is moving, and I think we're now thinking hikes instead of cuts. And these hikes are going to come more. There's going to be more of them if we don't get this oil price under control, which will lead to inflation, right? Mm-hmm. So that's the chain of events, right? Oil prices, inflation. Inflation means rate hikes, not rate cuts.
Now, with everything that's unfolded, we've seen oil going the wrong way today. Well, if you're filling up your car, it's going the wrong way. What's under control to you?
Well, yeah, good point. I think I see like a resolving of the Middle East crisis as being under control. So oil prices, there's been a supply shock. Like there's no doubt that will have to work its way through the market. So I think if we I have no say in this, but if we figure out the Middle East crisis, first things first, if that gets solved, let's call it, then the supply glut gets figured out. That'll take 3, 6, 9 months. I don't know. I'm not an oil and gas expert, but it'll take a while to figure that out. I think just the fact that you kind of resolve the Middle East crisis will give the central bank more opportunity to pause on rate hikes, whereby they'll let the supply thing figure itself out. Inflation will come, but they'll be more likely to pause hikes if the Middle East crisis gets solved. If not, I think you're going to see hikes this year. I think you're going to see one at least, maybe even two, and who knows, potentially 3 quarter-point hikes.
And for the investors, the Iran crisis, it's been a danger if you reacted to it, hasn't it?
Oh, yeah. And I mean, I see it. I'm on the front lines of this because I manage retail. I manage regular Canadians' money institutions as well, but retirees, business owners, and I see the VIX directly when my clients call me or they email me, and I sense it. I don't need to watch BNN to know the VIX. I see it when my clients call. You should
still watch, though, just to be clear.
Oh, dude, I watch all day, man. It's on. Trust me. It's on every TV in the office. But yes, we felt it. And every time there's a geopolitical event or a market crash, we always get that same phone call, right? Oh, do I need to sell? Do I need to sell? This time it's different, Roger. This time it's different. Hey, you know what? It's not. Surprise, surprise. It's not different. So we had some calls. We always do. Surprisingly, I feel like we had more this time for the relative percentage of movement in the market than we have in the past. Like I feel like COVID got a free pass. I feel like some of these last market moves, the interest rate in 2022, the inflation kind of crisis of 2022, I think we got more of a free pass. But this time it's different, Rob. Like they're bombing stuff in the Middle East. It's not great. We need to pull out. We need to sell everything. So we had quite a few emails, calls on that. And we actually had 1 or 2 capitulations, which is kind of crazy considering it was only a 10% negative move. So that means that person that, they're no longer invested in the equities and they missed this month of March or late March, April, which is, a 10% recovery. So we see it every market cycle. It's not different, but I think geopolitically this time there was a lot more noise. It was way more on our phones. It was in front of people's faces a lot more.
Yeah, it's all instantaneous. Now, you mentioned in your notes that since 45, there have been 30 major geopolitical crises. The vast majority of the market was higher. Do you know which ones where it wasn't higher, the situations?
Oh, that's a good point. You got me. I don't. I'd have to go back in my research and double check that. So no, I don't know. But I think we know historically, if you look 12 months out from these geopolitical events, this isn't like 2008 or, where there was serious underlying issues with the economy, inflation, unemployment, banks were going under, or, think of other kind of economic reasons why the stock market wasn't doing good. These geopolitical events, typically, they solve themselves out pretty quick historically. So I'm not surprised, to say the least, that happened this quick. And I don't think by any stretch we're for sure out of the woods yet. I mean, who knows what could happen with the president deciding what he may decide. But I think it's reasonable to see now these things solve themselves quicker geopolitically than economically.
All right, Rob, we got to wrap it up there. But thanks very much for joining us.
I appreciate coming on. Thank you, Roger.
Cheers, Rob. Rob Tetro, branch manager, senior investment advisor, and senior portfolio manager at Canaccord Genuity. Up next, the United Arab Emirates has decided to exit OPEC in May. We look at what this means amid the Iran war right after the break. The United Arab Emirates is exiting OPEC and OPEC Plus in just a few days. Now, this comes amid looming oil uncertainty in connection with the Iran war. Let's hear more now from Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Rob, thanks very much for joining us.
Thank you, Roger, for having me on.
Okay, we've heard this talked about. It's been bandied about. It finally happened. Was the Iran war the impetus for this?
Well, no, you're right. I think the UAE has been considering this and threatening this for several years, right? And so I don't know if that's the impetus or not, but obviously here's where we are now. We've got the UAE is roughly this third, I think maybe the second or third largest producer within OPEC. 10% of OPEC production now wants to produce whatever it wants to produce. And so we have the potential for additional supply to come online from the UAE. As much as 1 million barrels of spare capacity could be added to the already existing amount of global oil production coming out of the Middle East and out of OPEC in general.
Now, I mean, for the UAE, that sounds good. You get to sell more oil, never a bad thing. But is it a good or bad thing for it short term and long term?
Well, in theory, it should be for us as consumers, it should be a good thing because you think, well, the global oil market seems to be undersupplied, so let's add to the supply, which theoretically would reduce the price. That hasn't happened yet because, as you know, and you've talked about probably endlessly, is the Strait of Hormuz is, I guess, still closed, right? We're still not, or at least we don't have a free flow of oil through the Strait of Hormuz, and so there's a significant amount of supply of crude oil that's not flowing out of the Strait of Hormuz right now. Inventories are declining. Ultimately, we might have 1 billion barrels of oil of lower inventories when this is all said and done, and those inventories need to be refilled ultimately, and so that's kind of where we are right now. And UAE will help do that. Opening the Strait of Hormuz, though, will have the biggest impact on refilling inventories in the long run.
And with the UAE, is the Strait the only way for them to get oil out, or do they have alternatives?
I think generally that's probably I think that's their best option. In fact, I think that's probably the only option for them at the present time.
Okay, so what does this mean then for OPEC and OPEC Plus? Saudi Arabia, it's been constraining oil as well. Could this break up OPEC, or will it survive it?
Yeah, that's a good question. I think it's been a lot of people have called for OPEC's demise for a while, and it never happens, right? So I don't know if it would be good to predict OPEC's demise at this point in time. Probably not. But I do think that obviously it does show that there are countries that are dissatisfied with the quotas, and now we won't have, it'll be more of a free market, I guess. UAE will continue to produce, will continue to supply the market. It will probably increase production globally, and ultimately that will lower, in a longer term sense, that will lower the oil price because there'll just be simply more supply available around the world of oil, in particular from the UAE and from OPEC.
So what are the benefits for the other countries to stay in OPEC and OPEC Plus?
Yeah, no, that's a good question. Saudi obviously still leads up the charge there. Iraq is another large producer. Russia's still involved. The benefits are just what OPEC is trying to do is keep volatility out of prices, right? And that's what they say their stated goal is keep prices fairly stable, and that's what OPEC's purpose has been from the beginning. Some would argue that they've been ineffective at that, but that's the advantage of staying in OPEC. If oil prices get too low because the market's really oversupplied, well, then obviously they can cut the supply. If more volumes need to be introduced into the market, and like we're seeing now, well, that can happen. But obviously, the bigger issue now is the Strait of Hormuz, and that's been the biggest issue in the oil markets, really since the war began.
So are other OPEC countries, they're obviously aware of this, but are they paying attention to it, or are they still focused on what's happening in the Strait?
Oh, I think they're focused on what's going on in the Strait because that's where their revenue is coming from. They've got to get volumes flowing through that Strait of Hormuz so they can they can collect the revenues. Whether it's from China or India or Europe or any other country. But yeah, they're really focused on the Strait of Hormuz and wanting to get that open back up so that their oil revenues can return to normal, I guess.
And with the UAE leaving, could we see OPEC? Censor that? Could they try and put a blockade on the UAE from exporting their oil in any way?
Yeah, that's a good question. I don't think so. I don't think that the OPEC would do that. I think what would be more likely is, OPEC would and Saudi Arabia may just reduce its spare capacity and produce even more, right? And maybe Russia produces a little bit more oil. Rather than blockading everybody else. I think obviously the oil price for anybody in any country producing oil is very high right now, and so and produces a lot of revenue. OPEC is still relevant, or oil is still relevant, obviously, in the world. Global energy demand is going to continue to go up. Global supply global demand for oil is going to continue to go up, and so we're going to need some of that spare capacity going forward, and to refill these inventories, right? These 700 million to billion barrels a day, billion barrels of inventory need to be refilled over time, and that's just going to take a while. So we're just going to need more oil to be produced ultimately, whether it's by OPEC or the U.S. or Canada as well.
And I guess, how long do you think it'll take then for those countries to refill catch up and refill
that'll be
supplies?
Yeah. No, that's a good question. That's going to take months. That's going to take a while. That's just as long as it's taken for them to be depleted. It'll take just as long to refill them.
All right, we got to wrap it up there, Rob. But thanks very much for joining us.
Thanks for having me, Roger.
Rob Thummel, Senior Portfolio Manager at Tortoise Capital. Coming up, today's market drivers with Bloomberg's Monique Malima. Time now to take a look at today's market movers. We are joined by Bloomberg Equities reporter Monique Malima. Monique, thank you as always for joining us. We got a full sched today. Let's get right to it. Nucor is up first, and are tariffs helping it? Its numbers are up, eh?
Yes. So Nucor, they beat on their first quarter results. Their earnings per share came in well ahead of analyst estimates, and that was because they saw a growth in shipments for the quarter, particularly from their mill segment. Like you mentioned, they've been seeing the benefits from tariffs. They are an American steel company, so they've been able to benefit from the growing demand for domestic steel in the U.S. As there's been the high tariffs on imported steel. Analysts are really positive on the outlook for the company. They say that they expect that the second quarter is also going to see a growth in shipments as they continue to have some of these government supports. But they note that there could be pricing pressures ahead if some of these supports are reduced. And also with the upcoming USMCA renegotiations, that could also impact some of the tariffs on steel.
All right. Sherwin-Williams painting the town red, but in a bad way.
Yes. So Sherwin-Williams, they reported their results today, and their shares are now trading lower. They did beat on earnings per share, but they continue to see some weakness due to the consumer sentiment. Paint is something that can be very discretionary. So we're seeing, as there's the weaker consumer, that there's less demand. And the company said in their earnings that they don't expect end markets to recover this year. They see very little chance of that. So it has a weak outlook for the company going forward. And that's why analysts have been somewhat negative on the results, because they know even with the beat this quarter, the company maintained their guidance, which signals that the quarters ahead are expected to continue to be weaker.
Okay, next up, Galaxy Digital, and adjusted loss narrows, revenue decreases. Give us some more details on that.
Yes, so Galaxy Digital, they are a crypto firm, and they saw their losses for the first quarter being smaller than analysts expected. With that, they were still a couple $100 million, but this was less than the previous quarter and less than people had been expecting. This is largely due to the fact that they saw losses on their crypto holdings. They hold quite a bit of crypto on their balance sheet, and that value has gone down as crypto markets have declined. So they saw the value for that weigh on their earnings. But there's also been some weakness in crypto trading because of the declines that we've seen in the crypto markets. But analysts note that even with the weakness in crypto in the quarter, they were able to still keep their trading volumes roughly flat. And they see some optimism ahead for the company. They are transitioning to also be a data center business, and their Helios data center campus is just started to ramp up this month. So it should start to bring in revenue for the next quarter ahead. And analysts see this is really positive. They already have a deal in place with CoreWeave, and they're looking for other co-location partners. And this will help kind of diversify some of that revenue away from crypto so that they won't have as much of that volatility for the quarters ahead.
All right. And last one, Coinbase. What's going on there?
Yes, so Coinbase, their shares are trading lower this morning as Citi analysts note that there's a number of regulatory and legislative risks ahead for the company. Coinbase is currently facing a lawsuit by the New York Attorney General over their prediction markets platform, as is Gemini Space Station. So there's some regulatory risk there. And they also note that in the U.S. right now, the crypto market structure bill is still going through Congress, and there's a bit of a time pressure because Congress is going to take a break for Memorial Day, which will be in late May. And if it can't get passed by then there's a risk that it might be pushed off till after the midterms. This bill was expected to bring in more institutional investment by legislating some of the regulations around crypto. So if it doesn't get passed, or if we see changes to the rules in it that could be detrimental to Coinbase, such as rules around stablecoin yield or prediction markets, that could weigh on shares further. So analysts really see that there's a number of these kind of big risks in the near term.
All right, we have to wrap it up there. But Monique, thank you. As always, Bloomberg's Monique Malima. Up next, despite the war in the Middle East, the U.S. stock market is staying strong. After the break, we'll look at the reasons why investors aren't backing away. We are watching shares of Barrick Mining. It's off about 4% right now. The Canadian miner expects to complete the initial public offering of its North American division by the end of this year. The spin-off is expected to have its primary listing in New York and secondary listing in Toronto. The miner also appointed 7 executives dedicated exclusively to North American Barrick. The division will include stakes in its projects in the U.S. and the Dominican Republic. Shares of TFI International getting a boost. You can see they're up by more than 5.5% after the trucking and logistics company posted stronger than expected sales and profit in its latest quarter. Its profit forecast for the second quarter also came in higher. TFI says the results were driven by a higher profitability for both its truckload and logistics units, despite adverse weather early in the quarter. Shares of UPS are trading lower today, off about 4%. The parcel giant reported weaker than expected margins in its U.S. package business and also left its outlook for the year unchanged. The company's chief executive officer is also warning that high gasoline prices could potentially impact demand toward the end of the year. On the upside, the courier topped expectations for sales and profit in its latest quarter. Well, the U.S. stock market has held up during the Iran war after that initial dip. The data shows the conflict hasn't been the main driver of recent market moves. Instead, worries around artificial intelligence and a rebound in big tech stocks remain in the focus of investors' attention. For more on this, we're joined by Nir Kaysar, Bloomberg opinion columnist. Nir, thanks very much for joining us.
Thanks for having me.
All right, so the war wasn't as much of a factor in March as we thought. Why is that?
Yeah, I mean, I think, there's been a lot of volatility in the market recently, and that has coincided with the Iran war. And I think that has caused a lot of confusion about causation. And so, I went in to look inside the numbers, and what I discovered really is that the sell-off in March was really a continuation of the AI scare trade that started in February, and was more related to that than it was to the war. And you can see that in the numbers, because most of what drove down the S&P 500 in March was AI-related big tech and AI-related stocks. It was a lot less the rest of the market. And in fact, when you look at the rebound in April, that rebound has been led by a reversal of what happened in March. Again, really not related to stocks that you would think would be in harm's way of the war. I think what explains the rebound more is that, a lot of the big banks and money managers came out in early April and said, this AI scare trade is oversold, and it's a good opportunity for investors. And you saw a lot of buying, and up went the market.
Any other drivers for that surge with the tech stocks, or was it mostly just the bankers coming out and going, hey, there's some deals to be had here?
Yeah, almost exclusively. Now, some of that is explained by the structure of the market itself, right? Because the market is concentrated in the big tech names and in the AI trade in general. And so anytime you have movement there, you're going to have an outsized movement in the market itself. But still, that's where the action was. So I would say 80-20. You could apply an 80-20 rule to that. The vast majority of the action was in the AI related trades. Yeah.
And now we're seeing some movement again going the other way right now. Is that just some profit taking?
Well, I think, you have some news today about OpenAI. I think anytime AI is going to be in the news, you're going to have some sensitivity around stocks. But there's having said that, I think there's a related question, which is, if you accept the premise that this market is not really moving on the Iran war, it sort of raises the question, why isn't it? A lot of people look at that and they say, shouldn't it be? And I think there's some interesting data around that too. One of which is that, oil is just not that important to the global economy in particular, and the the global economy generally, and the U.S. economy in particular, than it was, several decades ago. And you can see that not only in the stock market. You can see that in the muted response of the bond market. The break evens are pretty well anchored. The 2-year Treasury yield is near the Fed funds rate. All of that tells you that the market does not see a lot of spillover effect from this Iran war yet, although obviously that can change.
I was going to say, if this drags on, then does it become an issue?
Certainly, if the war widens, you can expect that it's going to have more impact, because presumably it could affect supply, it could affect consumption. All of that would have a much broader impact, I think, on the market than it's had so far. But, you should look, I think, to the markets in general to they're going to give you the best indication of how worried they are about the widening of this war. And it's unusual when the stock markets and the oil markets and the bond markets are all telling you the same thing. The fact that the bond market has not moved much, the fact that while oil prices are higher, if you put the spike in oil prices in historical terms relative to other spikes from, let's say the 1970s on, what you see is that it hasn't been that dramatic a move after you adjust for inflation. We're up maybe 40, maybe now 45%. That's really a small fraction of the moves we've seen in oil in past decades. So I would argue that even the oil market's reaction has been relatively muted so far. And then, of course, we talked about stocks. They haven't really moved on the Iran war at all. When you see that kind of agreement across markets, I think it's telling you that the consensus is in, and the consensus is, unless this Iran war spreads more widely, it's just not going to have that big of an economic impact, at least not in the U.S.
And are there any other sectors that have either moved with tech, benefited from it, or taken a hit from it?
There hasn't been a lot of co-movement that we can, to such a degree that we could look at and say, aha, there's spillover effect from AI to, discretionary or staples or whatever it is. Part of that is because, even though we've had a lot of volatility recently, in historical terms, that volatility has not been that high. We never even got into a technical correction back in March, which would be, generally people would consider that a sell-off of 10% or more. when you have a move that's noteworthy, let's say, but doesn't even get into correction territory, you're just not going to have the severity to be able to look at relationships between sectors and say, this one moved that one. I would say on the whole that if you exclude tech, the sell-off in March and the recovery in April has been relatively modest.
All right, we have to wrap it up there, Nirba. Thank you very much for joining us.
My pleasure.
Nir Kesar is Bloomberg's opinion columnist. And coming up, tech stocks are under pressure, and there's a Canadian AI chip company betting there's still room to break in, though. We'll talk to the CEO after the break. Shares of General Motors are under pressure, even though the automaker posted first quarter beat and raised its full year outlook. GM is warning that faster than expected inflation is weighing on results as higher commodity, transportation, and logistics costs build amid the war in Iran. Earlier, Bloomberg spoke with Paul Jacobson, CFO of General Motors. Here's that conversation.
This quarter was a really strong one for us, but I think that resiliency word works really well. It's something that we've demonstrated for the last several years, whether it was the chip crisis or tariffs or inflation. I think the teams responded really well, and this quarter was no exception. When you look at some of the challenges that we faced around inventory levels, the go-to-market team did an outstanding job dealing with the traffic that we saw in the stores, which continued to be strong and steady and has continued through April. So we feel good about the quarter. And, we're able to take up our guidance as a result of the IEEPA tariff accrual that we took in the quarter. And, so far it looks like we're able to handle some of the pressure that we've seen in inflationary items, primarily resulting from energy prices.
Well, Paul, let's talk about that. It's an important topic. Your supply chains have been battle-tested, battle-hardened. The pandemic, the tariffs, and now this. What challenges are you working through as a team at the moment?
Well, I think right now, obviously, the team's done a really strong job of maintaining it through even some of the DRAM memory chip issues that we saw in the middle part of last year. I think a lot of that has calmed down, but what we're really seeing across the board right now is inflationary effects in raw materials, aluminum, steel, just overall transportation and logistics costs. We're calling out about $500 million of pressure that we've added to our forecast for the year. So despite our beat, we're not taking up our guidance by nearly as much as that beat, primarily because we're continuing to adjust the business. But we feel good that we're a little bit ahead of it right now, but we are cautious about how long this might last.
How much are you able to pass along those extra costs, Paul, to consumers in the face of already relatively high prices, but a very strong consumer demand?
Yeah, so we came into the year saying that price was only going to be up by about 0.5%, which really was the annualization of model year 26 price increases. We haven't built any significant price increases into our models. In fact, what we're seeing is the industry discounting a little bit more. There's some competitive pressure out there, but our team has held up well. I think when you look at the GM portfolio, we've really got a vehicle for every consumer out there. We're known for our trucks and our SUVs, but we sold over 700,000 vehicles last year with a starting price of approximately $30,000 or less. So we've got that portfolio. The Chevy Trax is hitting record levels for us last quarter. So we feel like we're in a good spot, depending on where the consumer might be.
Has there been any pushback against some of the large vehicles, the SUVs, the pickups, in the face of higher gasoline prices, or have you seen no ramifications whatsoever?
We really haven't seen any changes. In fact, our light-duty pickup sales were up about 8% year over year in the quarter. And like I said, traffic has been strong. If anything, we probably were a little bit light on inventory coming into the quarter because we had such a strong December, and with the weather in January and so on, we had difficulty making up those inventory levels. So we're down quite a bit from where we were a year ago. It gives us an opportunity to replenish that stock and make sure that we've got product in the stores at our dealers for customers when they come. But so far, traffic has remained steady.
Paul, when it comes to the tariffs, how is it going in terms of getting the refunds back from the U.S. government?
So, we're exposed a lot differently. I think many companies out there are principally focused on IEEPA. Many of our tariffs are under Section 232. And there's been a pretty robust process. We haven't had any challenges with the offsets and making sure that we're getting the accounting right with the government to make sure that the cash is flowing efficiently. With IEEPA, with the Supreme Court decision that was somewhat unexpected, we took the accrual. We have not moved our free cash flow guidance like we did our EBIT because we're not sure when that refund is going to come. We haven't applied for anything yet, but we're going to work through that with the government in partnership because I think that partnership has worked really well as we've adjusted and tried to benefit the U.S. auto industry the best we can.
Well, how deep is this partnership? A few weeks ago, there was a report that the Pentagon is talking to General Motors and other auto companies about making munitions and helping in the war effort. Is that accurate, and where are those conversations now?
Well, I can't comment on anything specific, but we do have a growing GM defense business, particularly with the infantry squad vehicle, which has been great for the troops and for the department as well. But this is taking advantage of really strong U.S. manufacturing, and that's where we lead the way, I think, as automakers, and do a great job. So, while we would rather not be paying tariffs across the board, we understand the environment that we're in, and we're making sure that we can pivot the business the best we can to adjust to that reality. And I think the team's done a good job when you look at the consistency of our earnings over the last several years.
The earnings speak for themselves, Paul, at a difficult time. And we talked all throughout this interview about the challenges on the horizon. How does that inform your approach to capital returns for the year ahead?
Well, our capital allocation policy starts with investing in the business. We'll put $10 to $12 billion in. Much of that this year is actually onshoring work that was previously done internationally. We're bringing that in as a result of our tariff response. The second pillar of our capital allocation is making sure we've got a strong balance sheet. And when you look at where our balance sheet is, how funded our pension plans are, we're in a really, really strong position. And what that's allowed us to do is take some of that free cash flow and allocate it back to shareholders to reward them for their confidence in the GM story and make sure that they're generating the returns for their customers as well. During the quarter, we were able to repurchase about $800 million worth of stock at about $75 a share, taking advantage of some of that dip and continuing to be very, very consistent about the way we apply our capital allocation.
Paul, when you look forward and at the potential priorities of General Motors, how much do you see EVs as playing a bigger part just because of some of the questions around oil, as well as, of course, autonomous driving?
So while we did take a number of charges, special item charges last year and even in the quarter as we continue to right-size our EV footprint as a result of the new regulatory environment, unlike many of our competitors, we're sticking with our models. We discontinued the BrightDrop van for very specific reasons, but we're not impairing any of our other EV programs like some of our competitors. We continue to believe that we can make EVs work through our winning platform. They're not affordable, or not profitable at these levels right now, and that's something that we've got to work on. So we've got a number of battery chemistry architecture initiatives coming in over the next couple of years that are going to get the costs down, and where we think we can take and continue our leading role. We're already number 2 in the U.S. In EVs, and think we can continue that and to continue to grow it in the future.
And that was Paul Jacobson, CFO of General Motors. Coming up, tech stocks are under pressure today as investors question the pace of AI demand, but a Canadian AI chip company is betting there's still room to break in. We'll speak with the company's CEO after this. Tech stocks are under pressure today as investors question how fast AI spending will grow. But one Canadian company is betting there's room for alternatives. Tenstorrent, a full AI compute company, is positioning itself as a lower-cost competitor to NVIDIA, unveiling a new system this week. But can it break into the market? Joining me now for more on this is the company's CEO, Jim Keller. Jim, thank you very much for joining us today.
Yeah, good to talk today.
Let's talk about your new product, Black Hole AI. You released that's coming out today. What is it, and how do you expect it to compete with it?
Yeah, it's a new kind of AI server. So we focused on lowering costs. So we use, lower cost chips. We put 32 in a box. All the accelerators have local DRAM and network connections. So we can hook a large number of chips together, both in the box and between boxes. We call this networked AI. It lets us scale to pretty large footprint at lower costs than, the competitors.
And who are your competitors? Are you trying to go up against NVIDIA, or who do you see yourself challenging?
Well, NVIDIA is obviously selling to the big hyperscalers. We see a real opportunity of selling to a wide variety of AI users who want on-prem computing. They want to be in neoclouds. They want lower cost. And they also want really open source software stacks. So we have a completely open source software stack and a wide variety of AI models up and running.
Now, any concerns on it's a difficult day with the Wall Street Journal report about AI service providers maybe running into issues financing things and also falling short on sales. Any concerns seeing that happening today and you releasing this?
Yeah, the AI world, if you follow the news feed, it's up and down every day, every month, every week. It's a really solid long-term trend, right? And then there's so many applications for AI outside of the big hyperscalers where the finance deal and the energy deal is the most important thing. Think about 1 to 20 megawatt data centers. Think about installs from, $1 million to $10-20 million where people want AI computers they can use, they can install on-prem, they have full control. It's like we're aiming at a different slice of the market.
And with that, would you be looking at Majestic Labs AI? Is that who one of your competitors are? Where are you going to get the funding from? Where's your optimism for that?
Where do we get it? Well, we have a wide variety of investors. We have a really solid pipeline. We did 4 supercluster installs last week. We manufacture with Quanta. They're a great manufacturer. So our mission right now is to basically ramp the product, install more computers, and then on May 1st, we're announcing really, really great benchmark numbers on a wide variety of models.
And is that where most of your capital spending is going to be going? Yeah, that $700 million that you raised, is that where most of that is earmarked for then?
Well, as you go forward, it's partly OPEX for people, facilities and everything. We are spending money on CapEx. As we start to ramp the product, there's lots of finance methods for that. We think that's pretty solid. So right now we're in pretty good shape. Our mission right now is to deliver product and, make people happy with new, AI computers.
And can you give a hint at what we can expect for, May 1st, you said? That
yeah, May 1st is the launch event. We've announced a couple of things. We run video really fast. We do 5 seconds of video in 2.4 seconds. Nobody's ever done that. We have really great, we just announced today in a couple of articles, 350 tokens per second per user with a big batch size on a big model. We're going to go into detail on that. We think the numbers are really good. And the key at Tenstorrent is we're not just like a one application, narrow focused AI company. We have a very general purpose compiler. We do video, image, LLMs, what they call prefill, decode. Our training stack's coming up. So we want a really general purpose AI computer.
And what about your manufacturing and supply chain? Where is that right now? Is everything in place?
Yeah, our current fab is TSMC, and we package it ASE. Quanta builds the boards. We also manufacture a whole bunch of parts at Vexos in Canada. We have a pretty broad supply chain, and lots of people working really hard on it.
And with that manufacturing in Canada, do you plan to stay there?
Oh, yeah, of course. Our next generation server, we're already in design with that. We do also some small development systems, which we manufacture there. So, yeah, you bet.
And are you doing any other work with Canadian companies?
There's a bunch of people in our supply chain. Our supply chain team is actually located in Canada. So we work pretty closely with a number of other companies.
And you plan to stay with everything there, even though you relocated down to the States?
Yeah, the corporate entity moved to Delaware. Our biggest office is in Toronto. We're doubling the size of that. We're moving in later this summer. We continue to hire there. Canada has one of the best intern programs on the planet. We hire a lot of really great engineers out of the Toronto, Ottawa areas.
And where do you see this going long term?
Well, AI is just starting. Like, if you read the news, you think there's all these boom and bust predictions, but it's going to continue to go into computing across the board. People are going to use it for more and more different things. We have some, opportunities in equipment manufacturers, IP, autonomous driving, robotics, but also the edge servers and the small data centers. It's a really broad range of applications. And again, our mission is to make general purpose AI, not a fixed function, not an accelerator, but really real AI computers.
All right. And for the company itself, is there an IPO in the future?
There definitely is an IPO in the future.
Any dates?
No dates. This is one of those things is you have to aim at the goal. There's a whole bunch of stuff you put together to build that business. We want the business to be solid, the margins to be good, the revenue to be growing. But in terms of how you build the company, finance, operations, investor relationships, we're building all that out. And I think we have a really solid team.
Okay, Jim, we have to wrap it up there, but thank you very much for joining us.
Yeah, thanks for having me today.
Cheers. Jim Keller is the CEO of Tens Torrent. Well, Market Call is coming up next. Today on the show, we have Andrew Moffs, Senior Vice President and Portfolio Manager at Vision Capital. His focus is real estate stocks. And that is it for Morning Markets. Thanks very much for joining us. We'll see you back here tomorrow.